Right now, precious metals are sitting in an eerie calm, and that should terrify you more than the chaos. When gold and silver go quiet, when volatility disappears and headlines fade, most investors check out. They assume nothing's happening. But here's what they don't understand. Silence in markets isn't peace, it's preparation. The market is loading the spring right now, building tension before an explosive move. If you're not paying attention during this lull, you'll be scrambling when everything erupts. And by then, you're not making decisions, you're just surviving them. It's February 2026, and I need to know when you're watching this. Drop the date in the comments because market context shifts fast. Also tell me where you're watching from, your city and country. I want to see how global this community really is. Here's the current picture. Gold's down roughly $10, hovering around $5,069. Silver is off about 50 cents at $81.75. These aren't the wild 4% daily swings we witnessed last week, or the 10% silver moves that made traders question their sanity. This is the market holding its breath before two critical events that could reshape everything. Wednesday brings the U.S. jobs report, and later this week we get inflation data. Employment figures reveal whether the economy's genuinely strong or just pretending. Strong jobs mean the Fed can delay rate cuts. Weak jobs force their hand toward easier policy. That directly moves the dollar, which directly moves precious metals. Inflation data matters because we're still haunted by rising prices. We've spent years on this roller coaster, and nobody knows if we've won the battle or if prices are about to surge again. When you see metals drifting lower on a Tuesday morning, don't mistake that for weakness. That's anticipation. Smart money isn't panicking or rushing. They're waiting, and there's profound wisdom in that patience. But while everyone's fixated on short-term price action, something seismic just happened that most people are completely missing. China just instructed its financial institutions to limit U.S. Treasury purchases. This isn't a minor technical adjustment. This is a strategic earthquake with massive implications for the dollar, interest rates, and precious metals. For decades, China has been among the largest holders of U.S. debt. But that relationship has been deteriorating. Trade wars, tariff battles, geopolitical rivalry, fears about dollar weaponization, all of it has made China increasingly uncomfortable. Now they're taking concrete action. Regulators are telling banks to reduce Treasury exposure and diversify away from concentration risk. The yuan surged on this news, hitting around 6.9 per dollar, near three-year highs. A strengthening Chinese currency signals capital flows are shifting. And it's not just China. Beneath the surface, there's a broad global movement away from dollar dominance. Central banks are loading up on gold. Sovereign wealth funds are trimming treasury positions. Alternative payment systems are being built to circumvent dollar hegemony. This is exactly what I mean about paying attention during quiet moments. On the surface, gold's down $10 and nothing seems noteworthy. Underneath, the tectonic plates of the global financial system are grinding against each other. Those shifts will ultimately drive precious metals prices for years to come. President Xi Jinping recently outlined ambitions for a powerful currency. That's a declaration of intent. China wants the yuan as a major reserve currency. Every step toward that goal supports gold and chips away at dollar dominance. Quick question. Do you think China's treasury pullback is short-term political posturing? Or is this the beginning of a fundamental restructuring of global finance? Drop your thoughts in the comments. Now let's talk about President Trump's recent claim that his Fed chair pick, Kevin Warsh, can deliver 15% GDP growth. 15%. The U.S. economy has averaged about 2.8% annual growth over 5 decades. In exceptional years, maybe you hit 3.5% or 4%. But 15%? That's not economic analysis, that's fiction. What this signals is enormous pressure. Warsh, if confirmed, will face impossible expectations. The Fed doesn't control GDP growth that way. It controls rates and liquidity, tools that can support growth at the margins, but can't magically transform a 2% economy into a 15% juggernaut. What happens when you set unrealistic expectations and reality inevitably disappoints? Frustration, blame, policy chaos. All of that breeds uncertainty, and uncertainty is rocket fuel for safe haven assets. Trump also called Powell a big mistake, which undermines Federal Reserve independence. When that confidence erodes, people lose faith in the institution managing the currency. And when that happens, they seek alternatives, stores of value that don't depend on political whims. They turn to gold and silver, assets that have preserved wealth for millennia. The recent volatility has left deep scars. Gold up almost 4% on Friday after falling similarly the day before. Silver up 10% after brutal declines earlier. At one point, gold was above $5,000, roughly $400 higher than Friday's low. Silver topped $80, nearly $20 above its Friday low. These aren't normal moves. The consequence? Gold ETFs saw outflows of about 20 tons last week, the first weekly outflow in 5 weeks, and the heaviest since late October. Money leaving ETFs signals spooked investors. Silver ETFs showed net inflows of 700 tons, but almost all came early in the week before volatility struck. After chaos hit, silver ETFs saw outflows too. Buying before the crash, selling after, that's investors getting crushed. A silver fund in China had to halt trading for an hour on Friday, then reopened and immediately dropped the maximum allowed 10%. That's pure chaos shaking confidence. The current pause is partly the market recovering from that trauma. Here's my honest assessment. The volatility isn't over. We're heading into major data releases. Geopolitical tensions continue simmering. China's making strategic moves against the dollar. Political pressure on the Fed is intensifying. Stacked together, large moves aren't just possible, they're probable. Let me ask you directly. Did recent volatility shake you? Did you reduce positions? Or did you hold steady? Tell me in the comments. Here's something positive. America's gold and silver, ticker USA, jumped 12% Monday after TD Securities issued a buy recommendation with 20% upside potential. What's driving optimism? Operational improvements at their Galena complex and spectacular production numbers. Silver production surged 52% in 2025, jumping from 1.74 million ounces to 2.65 million ounces. When miners ramp production dramatically while metal prices are elevated, earnings math becomes very attractive. I'm not recommending this stock. I'm illustrating what's possible in the mining sector. When underlying metal prices are high, production grows, and costs stay controlled, miners deliver exceptional leveraged returns. But leverage cuts both ways. When prices drop or production disappoints, miners get crushed. If you invest in mining stocks, do your homework. Geopolitically, Russia and Ukraine remain at war. Peace talks are happening, but Estonian intelligence suggests Russia is just buying time, exploiting negotiations without genuine intent to end the invasion. This is our world. Negotiations that might be theater. Powers preparing for future wars while current ones rage. None of this suggests safe haven demand factors are disappearing. Gold and silver haven't collapsed despite volatility because underlying uncertainty persists. The dollar is slightly higher today, creating headwind for metals. Crude oil's around $64.50. The 10-year Treasury yield sits at 4.1%. When yields rise, gold faces opportunity cost since it doesn't pay interest. When gold holds flat despite a stronger dollar and stable yields, that's actually strong performance showing underlying demand. For the jobs report Wednesday, here's the framework. Strong jobs likely means dollar up, gold down initially, as traders price in patient Fed policy. But strong jobs with rising wages could feed inflation concerns, creating complexity if later data confirms sticky prices. Weak jobs could trigger dollar down, gold up, as traders expect faster rate cuts. But weak jobs could also signal broader economic weakness, potentially triggering risk-off selling, where even gold faces pressure. We saw exactly that during recent chaos. I don't predict data, I prepare for multiple scenarios. If gold reacts bullishly, I know my levels for adding. If bearishly, I know whether to trim or hold. The key is having a plan before data hits. Technical levels matter. For gold, immediate resistance sits around $5,100. Breaking that opens targets at $5,300, then January highs around $5,450, then the all-time high at $5,598. Support is current levels around 5,069, then 5,000, then key support in the 4,900 to 4,950 zone. For silver at 81.75, resistance is 84 to 85, support around 79, then 75, then February lows around 64. Given extreme recent volatility, I focus on closing prices. Where the market settles reveals who won the day. Here's the psychological reality. This environment is designed to make you make mistakes. Volatility shakes confidence. Headlines flip constantly. We're about to get data that could move markets dramatically. The temptation is to do something, trade, adjust, get ahead of the move. But sometimes the right move is nothing, especially for long-term investors with conviction. The fundamental story, supply constraints, central bank accumulation, currency debasement, geopolitical hedging, none of that changes because of one jobs report. Are you planning to trade around the jobs report, or will you watch and let dust settle? Tell me in the comment. People often ask why I don't just tell them what to do. I understand the frustration, but that would be dishonest, because I don't know what will happen. Anyone claiming certainty is lying or delusional. What I can do is lay out analysis, show factors that matter, explain levels, and share decision-making frameworks. Your risk tolerance, time horizon, and circumstances differ from mine. I focus on education, not predictions. I want to make you a better investor over time, not someone dependent on following calls. If you only profit when someone tells you what to do, you're not in control. Hope isn't strategy. The goal is reaching a place where you understand charts, know context, recognize levels, have a plan, and execute with discipline. That skill creates long-term success. Let me bring this together. Gold and silver are pausing before major data releases that will catalyze the next significant move. Markets are recovering from extreme volatility that triggered massive ETF outflows. Beneath the surface, bigger forces are working. China's actively reducing U.S. Treasury exposure as part of broader global diversification that structurally supports gold. Trump's unrealistic growth expectations signal elevated political pressure on monetary policy. Geopolitical tensions provide ongoing safe haven demand. The key right now, don't let the quiet fool you. This pause is temporary. Volatility isn't finished. The setup for the next major leg is being constructed right now, while most people are distracted. Here's my final question, and I want robust discussion in the comments. Given everything we've covered, the data releases, China's moves, ETF flows, the volatility, what's your game plan for this week? Are you adding, holding, trimming, or sitting in cash waiting? Drop your answer below and let's build a real conversation. If you found value here, share this with someone confused by recent volatility, someone wondering whether to panic or hold steady. Context helps. Understanding helps. Sometimes knowing others are navigating the same uncertainty makes it easier to stay the course. The market is quiet today, but silence won't last. Data is coming. Volatility is coming. How you position yourself now determines whether you capitalize on the next move or become another person reacting after the fact. Stay sharp, stay patient, and I'll see you in the next one. This is educational content, not financial advice. I'm not your advisor. I don't know your situation or risk tolerance. I could be wrong about everything here.